Hey guys, welcome to a new episode of Retrospect. Please note this channel does not offer financial advice. Please do your own research and only invest money that you can afford to do. Today we're going to talk about major on-chain shifts happening right now in late November of 2025 and what that could mean for Bitcoin's direction going forward. The first on-chain shift is 580,000 Bitcoin being withdrawn in 6 days. Does this mean Bitcoin is preparing for a huge rally? So from November 21st to November 27th, 2025, data from CryptoQuant shows a drop from around 2.4 million Bitcoin to 1.82 million Bitcoin being on exchanges. That represents 580,000 units less on exchanges in under a week. That's one of the largest multi-day outflows seen this year and has raised questions across the market. Bitcoin is trading about 27% below its all-time high, and this fall in exchange reserves followed months of steady outflows. However, the pace of that recent move has stood out. It may suggest that larger holders have taken Bitcoin off exchanges, possibly into custody or cold storage. Sentiment, on the other hand, is showing that 91 new wallets are holding 100 Bitcoin and have been added since November 11th. That's new wallets. And the smaller wallets are dropping, pointing to a lower participation from retail users. The other thing is that Bitcoin's aggregated funding rate has turned negative, meaning that there are lower long exposures in the futures market, and it's suggesting that short positions are increasing and that longs are being closed. Now, this could be a turning point where an increase in price could liquidate those shorts, but we're just at that turning point right now, so maybe we need a bit of time before that happens. But all in all, I think this is quite bullish because there's less Bitcoin on exchanges, less available, meaning more demand, lower supply. Next is that Bitcoin miners are aggressively draining their reserves in a bid to shore up balance sheets against the historic collapse in revenue efficiency. Now, data from CryptoQuant also reveals that miners have transferred more than 30,000 Bitcoin, valued at $2.6 billion, from their wallets since November 21st, meaning total miner reserves are down to 1.803 million Bitcoin, which is the lowest levels on record, which signals that they are now pivoting from accumulation to survival because they're forced to monetize their Bitcoin to cover operational overhead as cash flows dry up. Bitcoin's hash price has fallen more than 50% in recent weeks to an all-time low of $34.49 per petahash per second. And compounding the pain is a stubborn disconnect between price and network difficulty, and this means that well-capitalized public miners are keeping next-generation fleets online despite negative margins. They are effectively subsidizing production with equity issuance or cash reserves. And this strategy squeezes out the smaller private competitors who lack access to capital markets. And there's a warning that if Bitcoin prices do not quickly reclaim their uptrend, the sector could face a prolonged wave of capitulation, where miners not only are liquidating their Bitcoin, but also their physical infrastructure. What do I think about this? I think this is bearish in the sense that these miners are dumping their Bitcoin on the market, but at the same time, it's more difficult for them to mine Bitcoin, meaning that it's harder for the production to keep up with the demand. So I have mixed feelings about this. The next shift I want to talk about is the fact that the expectations for the December Federal Reserve rate cut jumped from 30% to 85%. It's almost guaranteed we're going to get a rate cut December 9th. Altcoins have recovered, but the breadth remains weak. Now, 79 of the top 100 tokens are still more than 50% below their all-time highs, making this a very narrow cycle in terms of the leading altcoins. Cycle-critical liquidity channels like stablecoin supply, ETF flows, and digital asset treasury issuance have slowed in recent weeks, while newly launched altcoin ETFs continue to see steady positive net inflows exceeding $1.3 billion. Broader capital rotation remains limited, and near-term direction now depends heavily on the December FOMC meeting and the upcoming nomination of the next Federal Reserve chair, both of which will shape market expectations into the new year end. All in all, I think this is pretty bullish. You're going to have quantitative easing beginning and more liquidity in the market. And altcoin ETFs have posted steady net inflows. And last but not least, there's a hidden wave of selling from over-leveraged treasury firms. These companies raised billions in 2024 and early 2025 with a simple pitch that they'd buy and hold Bitcoin, Solana, and other crypto assets as corporate reserves, giving public market investors a way to bet on crypto appreciation without directly buying coins. But due to the price pressure, a lot of them are underwater because they bought quite late, and their funding structures are creating what analysts call forced seller dynamics at the wrong time. Now, if we look at the numbers, these digital asset treasury companies poured an estimated $42.7 billion into crypto throughout 2025, with $22.6 billion deployed in Q3 alone when the price was quite high. The strategy worked well when Bitcoin rallied from 60,000 in early 2025 to 126,000 in early October, but since that peak, things have reversed, and a lot of them will be forced to sell. When these digital asset treasury companies have a market to net asset value ratio which falls towards parity, meaning the stock price is roughly equal to just the value of the crypto it holds, management faces pressure to sell crypto assets to buy back the company's own stock. Now, if you think of that $42.7 billion they bought throughout 2025, if they are going to dump it on the market, you can just imagine what that can do to the price. So for me, that's really, really bullish, but one needs to keep in mind that this is totally different from MicroStrategy, because MicroStrategy is primarily in Bitcoin and they have manageable debt structures, but some of these smaller treasury companies bought more exotic and less liquid cryptocurrencies, and that's exactly where the risk could be much higher. But the risk is not about which assets they hold and how they funded those purchases. So guys, as you can see, there's a mix of bullish and bearish signals in the on-chain shifts happening right now. Tell me what you think about them. Leave your comments on the video, hit like and subscribe to the channel for future updates. Have a great rest of your weekend, guys. Bye bye.